Hello, this is Vince Edwards with Empire Builders. Here today to give you some more tips and things for startups and entrepreneurs out there trying to take their businesses to the next level. We hope to be the trusted resource for you guys from here on out. So if you want, hit subscribe. You're going to want to subscribe and get all the information. Today we're kind of going into our next level of tips and tools. We're going to show you, talk a little bit more about strategy of how really to take your business to the next level. So if you haven't seen some of our Series 1 videos, more getting you used to the funding process and going over certain definitions and jargon, you're probably going to want to go back to those because I'm going to kind of jump in here and really get serious and help you guys really turn something small into something really big. So for example, the name of this video is turn a 5K investment into a $5 million investment. So how do you do that? This is no gimmick, this is no trick. This is all about a strategic process of how you go about doing everything from A to Z. So let's just jump right in. First thing, when you start raising capital, the biggest important thing, it's like a marriage. It is investor selection. Just like picking a husband, picking a wife. If you pick the wrong person, no matter how hard you work, it's hard to get what you want out of it. So if you can start by selecting the right investors or as many of the right investors, that's going to help you be able to get further investments down the road and get your product, your service, your business to the next level, help you build your empire. So the first thing is you obviously look at all types of investor groups, angel investors, seed investors, groups of investors, but the number one type of investor to go after, high net worth individuals / investors. These folks are the best investors out there. And let me tell you why real quickly. Because one, it just takes one person to convince. They make the decision all on their own. They may seek some advisors or they may seek a little advice, but it's not like trying to sell a committee of 5 or 10 or a whole group of angel investors or a whole group of folks who work and do due diligence for a company, investor group, big investor group. So the number one best type of investor is a high net worth individual who has the wherewithal and the money to invest more money down the road. So the more of those type of investors you get at the early stages, the better off you are. Second, you want to make that type of investor, when you get 2 or 3 of these high net worth individuals, you want to make them part of the family. You want them to feel like they're part of the group, not just an investor who wrote a check, but someone who's going to help you go to the next level. Make them an advisor, make them a mentor, make them a company advisor. Give them a role with the company. You know, make them a CEO, CFO, something. But you want them to really want to be part of the growth and the roller coaster ride that you're going to take this product or service, this new startup company. You want to go through that whole roller coaster ride with you to get to the next level. You want them to feel the highs, feel the lows, but they're part of the team. They're going to want to keep this thing moving to see it to fruition, to see it to you are a success. Next, encourage them to recruit their friends and investment groups or buddies. This is key. Investors do like to do things in groups, but some of these groups don't always have to be a solid, concise group like an angel group that's fully formed with rules and regulations. A lot of these investor groups that invest, they're really loose groups of individuals who come together and just happen to tell their friends about their investment so their friends can come in for the ride. So encourage them to recruit their friends and other people, because guess what? If they bring their friends in or their co-investors, and they're the ones who suggested it, they have more stake for you to be successful because they don't want their friends to ride them out about having them put in a jump in on a bad investment. So you want to encourage them to recruit their friends and loose groups that they invest with. The next one is huge, and I talk about this when I talk about the funding rounds and the process. So go back and watch that video, but you need to hit your predetermined milestones for each round. When you go to raise money, every round you raise money, from your founders round to early seed rounds to Series A round, ought to have a predetermined milestone that you hope you're raising that money for. Something that this money is going to help you achieve for the business, for the outcome of the business. If you're able to hit those milestones, guess what? You're going to make your investors happy, and they won't mind putting more money in to keep you going. So they can keep putting in more money to help this thing keep going because they see that you're meeting your goals. You're hitting your goals, you're hitting your objectives, you're hitting those predetermined milestones like nobody's business. The next one, you want to be supportive of doing an anti-dilution clause for these investors. Anti-dilution, that means as more people invest, they have the right to put more money in to maintain the level of equity they got in their original investment. You definitely want them to want to keep having the same equity and put more money in, because it's easier to get someone who's wrote a check to write more checks. It's a lot harder to get someone who's never been involved to write a check. So the more involved your current investor group is, the more money you can raise from those same investors. The next step, set a minimum investment for a board seat. Almost all startups will eventually get to the point they have to have a board of directors. And investors like being on the board of directors. They like having say-so, and they like being a step above just any other investor. Set a minimum investment amount. They may have came in for $5K, but you may say it takes a $250K investment to guarantee a board seat. It's another way to get that person to write a bigger check or more checks. The next one is, you want those guys to lead those further rounds. When you hit those milestones and you go to raise more money, you want a previous investor to lead the next round. And what that means is, when you open a round up, you set terms for that round. If a previous investor is the first to invest in the next round, they're going to not negotiate and try to hardball you to make the terms of that next round fit more so their matrix than yours. So a previous investor is going to want to protect his previous investment. So that means he's not going to be hardcore if he leaves the next round. Why this is important is, whenever you raise capital based off SEC rules and even on private investment, your round, whatever you start your round with, whatever terms, it should stay consistent for every investor in that round. Not to say everybody does that, but that's the legality of what you're supposed to do. So whoever leads that round basically sets the terms. So if you don't want a cap put on a convertible note round, and you might want to go and watch the convertible note so you understand caps a little bit. But if you don't want another investor coming in saying, well, hey, I'll put money in this convertible note, but I want the value cap for when it converts to equity. And again, watch convertible notes and safe video. I'll go real deep into convertible notes and caps and that stuff later. So, but this is a series 2 type video, so I can't go into all these pieces right now. So you want somebody friendly to the company to lead each round. That way the terms can be set. Usually when you do convertible notes are safe, they're seed rounds or further rounds, and the investment doesn't convert to equity till a later round. You don't want that valuation capped. You want the market to determine that valuation. Usually it's tied, if it's a convertible note, it's tied to interest being added to that and a discount into that round. So that person who put that money up will get a better deal than someone who comes along to just invest in that equity round later. The next thing you want is sweeteners. Sweeteners are a great piece. And the big sweetener for private equity is warrants. Warrants are like stock options for employees. Warrants are basically, you're given the option to buy more shares or more units of the company, usually at exit when someone's buying it or it's going public or something to that matter. So what that happens is that warrant, you own the warrant. That means you can exercise it at the exit so that you don't have to pay for it. You don't pay for it and usually the warrants are at a lower price. They're usually at a previous equity round valuation. So warrants are usually issued so that you're getting a really great deal to exit. So for example, if it gets bought and the shares are sold for $100 a share, the warrant, you may have a right to buy them at $10 a share. You just got 10 times whatever the number of warrants you got at exit. So it's a great sweetener, and it's something that you like to offer, especially to previous investors who are along for the ride and they keep putting more money in. There's another type of sweetener called a side equity round or a sidebar round. I don't recommend this necessarily, but what happens there is, after you've done a convertible note round and you need more money, you may do what they call a side equity round, which is, it's not going to raise enough money to trigger the conversion of a safe or convertible note to equity. Say you put terms on that convertible note that it would not convert until you do a $10 million raise. Well, you may do a $2 million raise for equity that's outside of that. That's called a side equity round. And that's something you might offer only to these folks who really want to keep putting more money in, but they want more equity and they don't want to do it through a convertible note. It's another way to up that one investor's contribution from a small amount to a big amount. The other thing is, they will do loans for the company. A lot of these guys, if they're bought in and they're here and you need some bridge capital, They'll do low interest rates loans, which means another investment, not equity, but it's also a way to help the company keep moving forward. Now, the last thing I'll talk about is they should be part of the negotiation team for exit. You want them to be there negotiating the best deal with you. If this was a high net worth individual, they probably got connections, they've probably been successful in other lines of business, they understand negotiation, they understand business. You want them through from the rooter to the tutor, from the beginning to the end, and as you negotiate that exit, you want to be part of the team because they've given their heart and soul and money to this project just like you. They're part of the family. That's a big part of what we're talking about. Now, everything I just mentioned is about three things: inclusion, protection, and greed. One, you want to include that investor in everything because that means they're part of the family, they're part of the thing. Two is once they invest, it's like doubling down in Vegas. You want to protect your investment. You know, it's like buying insurance when you play in blackjack. You know, more money protects that they don't lose their previous investment. And the more money they put in, the more money it takes to protect their investment. And three, the almighty greed. And I don't mean greed in a bad way, but if they really feel this thing's going to blow up and that your business is going to go to the top, they're going to want more to share at the end. When it explodes and it's $1 billion company being sold for $1 billion, they want as much equity as possible so they can get that win-win when this thing is sold and everybody's happy and celebrating and having your celebration down in the islands drinking some type of sweet drink. Now, guys, this is strategy. This is not a trick. This is not a scam. This is part of an overall strategy. It's part of what Empire Builders does to help their clients go to the next level. Everything I mentioned to you is legitimate. It's not a scam. It's not a trick. It's just part of how, if you do business the right way, you can turn a small investment into a big investment that gets your company where you need it to go. It's a process. So guys, I'm going to teach you all the insider traits and tricks of the game of raising capital, from what's done in New York to what's done in Silicon Valley. You need to subscribe. You need to watch the videos. Get motivated. Get ready to take your business to the next level. We're not playing games. Come join the Warrior Nation. We'll get you there. You can do it yourself, and I want you to do it yourself if you can. That's why I'm doing these videos, to give you an insider's look and take you to the next level, what really goes on when people are raising capital and building these huge businesses from scratch. This is the same thing Zuckerberg did, the same thing Jobs did, the same thing Gates did. They've all done this stuff. It is not any kind of trick. It's all about what you do, having the knowledge, learning the right process and structure, and making it happen. My goals for 2019, execute, execute, execute. I'm going to kill it. I want you to kill it too. Give a homage to E.T., Eric Thomas, one of my motivational guys. You know, somebody should check out sometime. I'll have some links down to some of the videos that may help you understand what we talked about today. But again, I'm here for you guys. Take care, hit subscribe, love you, keep watching the videos. Let's take your business to the next level.